This is the S2G podcast. I'm Tonya Bakritzes. In this episode, I sat down with Sanjeev Krishnan, managing partner at S2G, to discuss the Age of Adaptation and how company leaders and investors can navigate this time of profound uncertainty and opportunity. This podcast is for informational purposes only and should not be construed as legal, business, tax, or investment advice, nor should it be used to evaluate any investment or security. It is not directed at or intended for any current or prospective investor in any investment vehicle sponsored by S2G. Investing involves risk, including the potential loss of capital. References to specific companies are for illustrative and educational purposes only and do not represent an endorsement or investment recommendation. The views expressed by podcast guests are their own and do not necessarily reflect the views of S2G. For additional important information, please visit s2ginvestments.com/disclosures.
We've crossed Rubicons before. We've traveled continents. We've innovated on every single thing that we can do. We have to look at this age of adaptation to challenge the status quo. And people with duration, people with patience, people with an ability to build businesses that are profitable and cash flowing, I think can really outperform in this market.
By now, you're probably tired of hearing the phrase unprecedented times. But whether it's a pandemic, geopolitical conflicts, or extreme weather events, something has definitely shifted. We're entering a new era of volatility, one that demands a different playbook from the last 50 years, when cheap capital, globalization, and a stable climate shaped the way we built and invested. This year, the theme of our annual S2G Summit was the Age of Adaptation. And in this episode, I sat down with Sanjeev Krishnan to unpack what that really means for company leaders and investors navigating an increasingly unpredictable world. We explore the four forces shaping this landscape: AI, geopolitics, the shifting monetary regime, and climate adaptation. Sanjeev unpacks why resilience is a measurable, investable opportunity, how AI will shape labor markets, battery demands, and global power needs, and why the challenge of competing with China and rebuilding mission-critical manufacturing will define the next industrial era. For company leaders and investors able to brave the storm, there's a chance to build enduring businesses that don't just weather the volatility, but actually thrive because of it. Thank you for joining me, Sanjeev, so early in the morning. We just wrapped up our summit about a month ago now, and the theme was Age of Adaptation. What does that mean to you, and why is it such a critical area of focus?
I think adaptation is not about climate or just about climate. It's a broader theme of adaptation. I think the notion that I've had, and I think we're evolving to, is we're exiting sort of Nixon's world order. I think the early 1970s really, in my opinion, set the framework for the modern sort of world order. Nixon took America off the gold standard and really unleashed sort of financial liberalization that continued till today, to Nixon and Kissinger's sort of embrace of China, and then their eventual entry into the WTO really led to what we call today kind of globalization, in my opinion. Besides monetary and geopolitical order, I don't think this was Nixon, but the federal government with the private sector really unleashed Moore's Law, which is a miniaturization of electronics and compute speed, such that led, I think, to the hardware and then software revolution, and frankly, sort of the digital computing modern age. And demographics globally were very much a dividend. You had the boomers, you had the rise of the middle class. So you got from, depending on your definition, middle class and purchasing power parity, you've gone from 500 million middle class to 3 billion middle class globally. That's led to consumption and demographics. Yeah. All those four, I think, in my opinion, are ending, or at least ending the way that we've pursued. I think for the first time in 40 years, we do not know fully the marginal buyer of the 10-year treasury. In the 90s, you've had Japan, then China, and then the Fed. Each of those marginal buyers of the 10-year and 30-year really did that with the notion of either exchange rate suppression or financial stability. And today, I would argue the marginal buy of the 10-year is unknown and the store of value is unknown. It's not necessarily a post-dollar world today, but I think the monetary regime is going to have to be adapted to. I think geopolitically, we've had the most conflict since World War II. There's clearly a desire, I think it's fairly bipartisan, about more burden sharing about financing the global public order and global public security. That burden sharing conversations, I think, is going to lead to a more multipolar world. We're already heading to a multipolar world. And then third, is this revolution between CPU and GPU. And so parallel computing and the advent of artificial intelligence is going to be a shift. And even if we're talking about sort of 2.5 degrees, which is my base case personally, you have a shift in monetary order potentially that needs to be adapted to. You have a geopolitical order that needs to be adapted to. And you've got a technological order that is fundamentally shifting that needs to be adapted to. And then you get to the notion of climate. And I think just given consumption patterns, there's been a lot of progress, but fundamentally, I think we're headed to 2.5 degrees, just given what I see. That's not to say we shouldn't do mitigation, but we need to figure out how to adapt to that world, whether it's forecasting weather and its implications in power markets, real estate markets, reinsurance markets, ag markets, whether it's physical assets and how that performs, whether it's how to build resilient supply chains in the face of 2.5 degrees. Forget the migration impact, forget sort of the other impacts. So I think the age of adaptation has been here really since COVID.
Yeah.
The last 5 years, I think we've gone from an era of moderation to an era of volatility. And that's across every metric that I see that are germane to allocating capital, building companies. So the premise of the summit was, how do we prepare for those 4 fundamental shifts?
Right. Yeah, and we'll dig more into each one, but I think we're sitting here in Chicago in a heat wave under a heat dome. We're feeling the shift to 2.5. Can you talk a bit more about how you think about adaptation versus mitigation from an investor's perspective?
Yeah, I think you have to walk and chew gum. I think the reality politically is this has to go from green premium to green discount. So cheaper, faster, better is the notion. And I think in order to do that, you need fundamentally, this needs to be about resource productivity. And so this is actually the more productive thing to do. The way that I think about the definition of climate transition is the equation of taking useful energy and turning it into useful materials. What we focus on investing in is calories, electrons, energy density, molecules, and water. Those are 5 things that I think the world needs fundamentally every day, every hour. And the notion of mitigation, I think, it has to be about productivity. And we've been doing this for 10,000 years, thermodynamically. So fire, photosynthesis, fossil fuels. And thermodynamically, I think the practical reality is it's probably all the above strategy, just given where we are today. And in that respect, like, we have to come up with the physics, biology, chemistry, and that sort of shows citizens and consumers that this is actually the more productive and more resilient thing to do. And in different parts of those 5 commodities we work in, you're seeing that. But I think that can't ignore the reality today that some of this stuff is a premium, some of this stuff is not productive yet. And the political reality is that we're going to have oil and gas for a long time, unless something else dramatic happens. And so then I sit there and I say, we're going to 2.1. That is not to say we shouldn't figure out productive ways to do mitigation and, frankly, productive ways to do adaptation. I think we're just saying you have to walk and chew gum at the same time.
Yeah, totally makes sense. Building on the conversation of mitigation and adaptation, the first set of speakers at the summit discussed the implications of moving to a 2.5 degrees of warming. Dr. Parag Khanna, founder of AlphaGeo, talked about adaptation as an inevitable and significant business opportunity.
Locations that fail to adapt are going to experience not only the obvious physical devastation that we observe, the economic loss, the currency displacement, debasement, and population decline, But conversely, of course, resilient geographies are going to attract capital, investment, migration, business, infrastructure, and so forth. And therefore, adaptation is actually the best risk mitigation strategy and also the best absolute return strategy in the long run. So investing in adaptation is not just insurance, it's also something ultimately about the right business model fit to the future.
Spencer Glendon, founder of Probable Futures, and Barney Schabel, principal at Greenthread, discuss the risks of climate change not being considered and the implications for the insurance industry.
If you're not seeing an appropriate price for whatever risk it is that you want to cover, that price isn't in your budget, it isn't in your forecast, it isn't in your decision making.
How are you thinking about resilience as both an investment lens and a measurable business opportunity?
I think I was struck at a meeting I went to recently where this person was a trader at a pretty large firm and basically was like, I trade the weather implicitly. And whether you trade power, whether you trade ag commodities, effectively, like you're trading the weather. And if you think about the regulators of weather, which is a lot of ocean related activities, we're putting 2 Hiroshima bombs a second of excess heat into the oceans. And at some point, that thermodynamic loop of heat absorption is going to break, and it's going to have impacts on whether winters are excessively hot, which has implications to power and natural gas and a host of downstream commodity impacts. I think that the externality, which rarely gets priced into most capital markets or in most capitalism frameworks, it has to break through the real economy to capital markets. And I think that's sort of what I think Barney and Spencer are talking about. I think Parag's thesis is really around, first of all, humans have always adapted. We have probably the greatest migration patterns occurring through human history, like right now in the last 5 or 10 years. We've never migrated despite all the political issues that creates as much as we've been doing in human history. And there's a set of assets that will be stranded and there's a set of assets that will actually outperform. And I think the set of assets that outperform have certain characteristics around water availability, localized climate patterns, people that want to live there and raise kids there. And there are certain geographies where there's going to be, frankly, some stranded assets. And the feedback loop could be, are those properties insurable or not? So I think it's like, what's the alpha opportunity with regard to these changes? And so I think the sort of notion of adaptation is both around, like, how does this impact the real economy? How does it impact capital markets? And not just around risk, but also there is going to be areas that will outperform. And so it's just not that the beta is changing, but also there's alpha within this as well. And it's just prudent practice to understand the winners and losers. Just like every major trend has winners and losers, this will have winners and losers.
Speaking of winners and losers, AI is fueling a lot of change and innovation. Ranveer Chandra, CTO of AgriFood at Microsoft, and David Douglas, CEO of Sensei Ag, discussed how companies need to start thinking in terms of people plus AI, and that AI should be the top bullet in any pitch deck.
Every once in a while, technology happens that just changes what's possible so radically. And I think about it as like a technology overhang, where the technology and what's capable is way beyond what we are. And I think we're at the same point in AI right now. We've got this huge technology overhang where AI could stop today and we could just use what we already have. And it'll take us 4, 5, 8 years just to figure out how best to use it.
Futurist and entrepreneur Sinead Boval discussed how AI will move from being an assistant or product to becoming infrastructure, which she foresees will completely change the way people operate.
So what might the edge of a market look like right now? We saw the rise of B2C. We are very familiar with B2B as a result of SaaS. The internet brought us direct to consumer, D2C. So could the edge of the market be working on AI to C, where AI is the designer? AI is the product that goes straight to customers, right? So again, it's not that incumbents get out-competed, but the metrics they value no longer matter when the infrastructure changes.
How are you seeing it evolve in the sectors we work in? And what do you think's ahead for how this changes business fundamentals?
I think I've been on the road a lot the last 2 years, and it's particularly the last 6 months. It's like non-verb adjective AI, non-verb adjective. Like it's in every thing you go to, any conversation you have. There's clearly going to be significant investment in GPU chips and other things that allow for more parallel computing and significant GPU compute that will then allow for LLMs and eventually, I think, reasoning AI and then physical AI are the two sort of end states of this. If that happens, the level of power need is obvious and has been talked about. I think the relationship between labor versus capital is going to create adaptation needs. Clearly, if this works, there'll be labor substitution and opportunities for capital that has issues around income and equity and cost of living and et cetera. I think the question that I was hoping with that panel, is it fundamentally disinflationary and is it fundamentally more productive? And then who does that value accrete to? And I think it's still early, I would argue, on all of this stuff. I was at a meeting at Milken, and I entered my career in 2000, and I did tech, media, telecom, M&A at JP Morgan. And at that point, everyone was talking about fiber and telecom and the internet. And it just took 8 years longer or 9 years longer for those. And there was a ton of investments that were just stranded because there was both technological progress on telecom and also it was not the level of connectivity, and the tech bubble, sort of delayed the eventual adoption of these assets. And I asked, it was a group of asset owners, and they all were like, we entered AI very skeptical, and now we're thinking this actually is maybe bigger than we think.
Wow.
And AGI is closer than we think. And I think with all these things, it's like how wrong we are about our predictions, not how right we are. And I think one of the things I admire most about American capitalism, and I think it's very different than every other capital market system, it's willing to finance collective magical thinking. Oh, there's a thing out there. Let's go fund it before build it and they will come is one of the great American capital market characteristics. We did this in shale. We've done this in biotech, hence Moderna, hence America's the number one producer of oil and gas. We've done this with technology in the 90s. So we are going to do this.
Yep.
And I think if reasoning AI and physical AI show up, it's going to be dramatic impact. I think the power thing has been talked about for quite a bit, but if you think about physical AI and humanoid robotics, they figured out dexterity, you figure out labor substitution from changing hotel beds to servers and food or factory workers or humanoid robotics. The thing that I think is being underestimated is the level of battery need to fund physical AI and all the other critical minerals that we need, because all of these humanoid robotics are going to have to be powered with some level of batteries. And so I think in addition to the power demand of AI, I think that the battery demand is not to be underestimated. I think in terms of what we do, calories, electrons, energy density molecules, and water, these are very underpenetrated IoT industries. So there's not a lot of labeled, structured data that then you can build foundational models to then do it. Whether you're trying to predict weather, predict yield, predict power pricing, predict flows of trade, and et cetera. I think AI will show up in the verticalization of agriculture or ingredient discovery or power load prediction or all shipping routes, et cetera, et cetera. But I think it's going to take a little bit longer because it's not like the data is as detailed and as labeled and as structured.
Makes sense.
We've been funding a lot of companies across the last 11 years to really invest in high quality training data that then has real world use cases. So Centera, just acquired by John Deere, has real world unique data around that's label structured around weed management in agriculture. That took a long time before the AI could be turned on. There was a lot of just hardware investments that need to happen to get the data to eventually be useful to farmers, to John Deere, to others.
As we think about the rise of AI, it raises the topic of battery needs and critical minerals, which in turn brings up the topic of geopolitics. Damien Ma, founder of Marco Polo and faculty member at the Kellogg School of Management, spoke about how competing with China in this fourth industrial revolution means that the U.S. must rediscover its capacity to build fast and build well.
It's really fundamentally an economic race. And to win that race in the 21st century, this competition boils down to who's going to capture the benefits of the fourth industrial revolution. What is that fourth industrial revolution? It's really two big things: abundant electrification and abundant intelligence.
Are there promising trends you're seeing that could indicate the U.S. is on a path to regaining its competitive advantage?
There's a real debate around what we want to onshore, what we view as mission critical manufacturing, mission critical mining and metal supply chains, mission critical ways that we're going to do this competitive, whether it's with China or frankly anybody. I think that debate is still occurring, and I don't think we've really settled on what the policy incentives are going to be for the private sector to make those investments, because just the clustering impact of outsourcing a lot of manufacturing to China or other parts of the world, those clustering synergies that they have, whether it's the Pearl River Delta or other things, are just fundamentally advantaged in terms of the process has become the product almost, because they know how to do the manufacturing process that's evolved in them to having a competitive edge of product. And technologically, I think there is a lot of advantages that China has. So I think geopolitically, this divorce with China is going to be, I think, expensive and take a ton of investment. And I'm not sure which one of those investments the private sector will do and which ones will need help from the public sector. And I'm not saying that the U.S. shouldn't try to make sure they're self-sufficient, but I just think, are we really ready for the inflationary impact of this divorce with China when we're worried about inflation so much?
Right.
And what is the handoff so that it's not so inflationary? And obviously everyone looks at robotics and automation and bringing manufacturing jobs that are high value, that are mission critical here, also having more metals and mining in America. I think all those things are great and we need to do them. But I think it's really going to be hard to do this divorce from China. And so is there a grand bargain with China that you can make where you can still bring the mission critical stuff? Because I think the origins were always there, but it really came into effect in COVID when we didn't have access to fundamental supply chains and that we needed. And so I totally understand the thesis. It's just, are we ready to invest in it from a private sector perspective? And if we need public sector incentives to make the investments pencil out, is that ready to?
The last theme you teed up in the Age of Adaptation discussion was the change in monetary regime. And Dimitrios Volatzes, founding partner at Aurora Macro Strategies, spoke about the shifts reshaping the global financial landscape, including the gradual decline in the U.S. dollar's dominance amid rising fiscal pressures and geopolitical fragmentation.
Now, today, the real equilibrium rate is determined by the balance of savings and investment. Broadly speaking, lots of savings, chasing few investments, lower interest rates. Fewer savings, lots of investment opportunities, that means higher real rates. And I will argue today that the price of money is shifting across space and across time, from US-centered to global fragmentation, and from secular stagnation to the AI era.
How do you see macroeconomic shifts impacting long-term investment strategies in the sectors we work in?
Yeah, so the sectors we work in are low margin, capital intensive for the most part, regulatory sensitive, oligopolistic in nature. There's very limited risk management teams and very limited exits, which what we've built the firm around, this warts and all approach to these sectors and with different strategies for different asset classes. I think the capital intensity piece is not to be lost. Obviously, if capital is going to be expensive, capital intensive things are going to be harder to fund. And I think this is where I'm very curious to observe and listen, because again, I think we've been blessed to be the reserve currency. I think things like kicking Russia out of SWIFT, the volatility of of our debt deficit issue, which is real and needs to be addressed sooner than later. This is before Medicare, Medicaid really become a greater part of our budget than they are today.
Mm-hmm.
And so you've got a combination of massive debt and deficits and interest payments to just a multipolar world where they want more than one reserve currency, but really doesn't have a path today, but it could, based on this combination of things that are occurring. And this lack of this marginal buyer of the 10-year that we spoke about earlier. I worry that we have structurally high cost of capital. And if you're trying to build multi-billion-dollar data centers with power, if you're trying to build modern manufacturing to hedge geopolitical tumult and supply chains relying on chokeholds, which we talked about earlier, this is going to get expensive and again going to be inflationary potentially, because if you have a high 10-year, that's going to translate across the economy. And so I worry about a capital intensive approach to some of these sectors. And so we're trying to invest in more capital light models for the most part. And then two, I think it's going to create a conversation around where else, especially in the commodity markets we work in, where else do you allocate capital besides some of the areas we're focused on today? And this is where I'm excited about some of the real asset work that provide an inflation hedge, that provide a non-correlation technically. And so there's some interesting things that you could do to position yourself in the adaptation of the evolving monetary landscape.
Yeah. You mentioned a couple thoughts on how, as investors, we should react to these forces and think about investing in an age of adaptation. But can you say more about where you're seeing opportunities and how we should think about beta versus alpha?
I think beta is sort of the embedded reality of today. What everyone collectively believes is like the reality. And that's my simple way. And then alpha is sort of outperformance to that beta. I think everyone, asset owners on down to entrepreneurs, want to outperform the thing that is the average, right? They want to outperform the mean. We do, entrepreneurs do, asset allocators do, everyone would technically like to do that. My own feeling is now I think the beta is fragile, conditional, crowded, and concentrated. And then the alpha to me is about, is your portfolio, is your company able to absorb these nonlinear trends that we talked about earlier, these shocks that frankly are occurring with greater frequency, whether it's geopolitical shocks that we've had with Israel and Iran, whether it's economic shocks, whether it's 2.5 degree related shocks, whether it's monetary shocks. Is your business able to absorb that? And then in addition to that, could you actually build anti-fragile businesses and companies and investment portfolios that actually maybe even not just survive, but thrive in volatility? And I think we are looking for businesses that have that anti-fragile component to them. It is not easy to build, but I think there are some ingredients that I think are there to observe when they're built.
Yeah. Is it the construct of the business, or are there certain subsectors within our sectors that you're most excited about?
First of all, it's really hard to fully divorce from the world and build this like anti-fragile thing that's never fragile. Like at the end of the day, like all human activity is fragile and all economic activity that is driven by humans is fragile. So let's not pretend that there's something that is super, just a silver bullet that will cure all shock volatility. But there are some companies that do better or worse. And it's really, hey, we're going to either normalize volatility because we are producing something that is closer to consumption, so it doesn't have a long supply chain. And instead of being for a premium, it is actually a parity or discount to the thing that you want. Feedstock volatility exists. And if you can take that feedstock and normalize the volatility, you should technically, if you continue to have shocks, be more resilient and cheaper than the alternative. I think if you're deflationary in general, I would argue you're creating anti-fragility, depending on what specific thing that you're doing. It's interesting to talk in high level, but these are like company by company, industry by industry, business characteristics by business characteristics. There's a lot, I think, in our portfolio. We've got a software business that helps field services and utilities recover when there's a weather shock, right? And so they're actually getting more clients because there's more and more weather shocks. That's leading to more and more need for utility field crews to be needed. And this company has a software tool that allows them to do that. I think if you have backup power needs, because the grid is unstable and or there's these shocks, you have backup power needs because there's a lot of AI data centers being built and those things have to have effectively 100% reliability. Those customers have the money and willing to pay for reliability. And if you're cheaper than the current alternative and have less feedstock risk, I think that is important. If you think about our debt and deficits and monetary order, we're going to be in a debt struggle, literally, between the Hippocratic Oath and the bond market. If you look at 1,000 years of history, the bond markets tend to win. If you're a food company that's allowing you to lower healthcare costs, particularly with aging boomers, that to me is anti-fragile because you're not just helping the taxpayer save money, but you're creating better patient outcomes and you're helping the system, both the healthcare system and the food system, become more productive. And you're helping the monetary order because you're spending less on Medicare Part D or whatever else you're doing. And so I think there are companies out there that I think can thrive in the age of adaptation. And again, when I say that, it's all these four characteristics, right? Cost of capital, geopolitical order, CPU to GPU, and 2.5 degrees.
Interesting. What gives you hope in the face of all this volatility and need to walk and chew gum between mitigation and adaptation?
I think the combination of the monetary order potentially changing, the geopolitical order evolving, AI coming into it at 2.5. You could argue we've never had a more binary set of compounding events. Like you could lead to techno-utopia or like techno-feudalism in dystopia. And what I think that we have is agency as individuals, as leaders, and frankly, our ecosystem more than us. They all have the power, if they chose to do it, to bend the future towards feudalism or utopia. Not that the world is ever that binary. It's rarely ever binary. So it's the gradients of gray. But I think we look at these four things, and even as a father of 3 kids, like there's a dystopia that sets in. But I think entrepreneurs and leaders often also have a utopic frame for these things, that we can actually innovate and get more resilient and more productive, and things get cheaper, faster, better, and use this as a moment of human adaptation, which we've done through history. We've been around 10,000 years. I'm hopeful we're going to be around for another 10,000 years to see this. And I'm optimistic mainly because I actually think the people in my kids' generation, even, they have a sense of vision, strategy, tactics to build products and services that actually take advantage of these four things, as opposed to have a dystopic view that's fairly passive. There's a lot of people with agency right now trying to make things happen. I think the search for outperformance, or the search for challenging the average, is, I think, rooted in human history. The notion of sort of anchoring around the current system and then trying to profit from a shift, I think, has been occurring for at least 2,000 years. We've crossed Rubicons before. We've traveled continents. We've innovated on every single thing that we can do. And I think we have to look at this age of adaptation to challenge the status quo and to sort of understand what the future is. I think humans are naturally, and investors in particular, are naturally schizophrenic. This is professional schizophrenia, this job. And I think particularly the last 12 months, and maybe the last 2 years, maybe, when we left zero interest rates and we went to more structurally high rates, and risk off happened in capital markets, and there's a lack of exits for even private equity bad firms, forget venture or growth stage. There's been this, frankly, anxiety and pessimism that's occurred. I personally saw that in 01, 02, 08, 09. It is not for the faint of heart when you're going through it, but I think if you can come out the other side with leadership, with tenacity, with a focus on building real products with real margins, with real EBITDA and cash flow, I think there's a tremendous opportunity if you can be financially sustainable and have a dramatic impact on adaptation, whether it's just one of the four or all four. I think there's a significant value creation opportunity for companies, entrepreneurs, and even corporates to partner with us on that.
Perfect. I think that's a great way to end, Sanjeev. Thank you so much for your time today.
Thank you.
In our next episode, we'll explore what it means to build companies that can thrive in a world of growing volatility and how to operate with an adaptation mindset. We'll be hearing from Corey Capasso, CEO of Urbint, a company that uses AI-powered risk prediction to help utilities and infrastructure providers prevent accidents, protect workers, and stop damage before it happens. Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2ginvestments.com.